So, welcome everybody to Wealth Briefs, and we're going to go ahead and get the show on the road here. If you've ever wished your investments worked as hard as you do, well, tax breaks and black gold, how smart investors win big, will introduce you to a misunderstood asset class that savvy professionals are using to lower taxes, build passive income, and own a piece of America's most essential resource. This isn't speculation, it is appropriate strategy. So, just one more time before we get started here, if you haven't yet, pop over to the chat and enter your name and tell us where it is that you are coming in from. The chat remains open throughout the presentation, so you can go ahead and put your questions in there at any time you would like to. And after the presentation, we will get to any questions that you may have. So, welcome to Wealth Briefs, where we spotlight powerful strategies to help high income professionals stop exchanging time for money. We're brought to you by Royal Legal Solutions. The founder is Scott Smith, and Royal Legal Solutions specializes in helping investors reduce tax liability and protect their wealth through advanced legal structures and asset protection strategies. I'm your host, Dr. Alan Lomax, the founder of Steve Talker Capital, where we mentor professionals like you to create passive income through secure, high yield investments. Our mentoring isn't just about dollars, it's about reclaiming your time, creating freedom, and building wealth that aligns with your values. If you're ready to explore what this could look like in your life, I invite you to schedule a high value, complimentary one on one coaching consultation with me. The link to schedule that is at the top of the chat. There's a few spaces left, so if you'd like to do that, go ahead and schedule that. I look forward to meeting with you on a one on one basis. Just as a brief disclaimer, all information shared on Wealth Briefs is for educational purposes only. It is not to be construed as investment, financial, legal, or tax advice. All investments incur risk. You should not invest if you are not prepared to lose 100% of your investment. Always consult your legal, accounting, and tax advisor before making any investments. If you've ever wished your investments worked as hard as you do, well, today's guest brings a strategy helping professionals cut taxes and build passive income through real asset ownership. Vishal Grover joins us from Wealth from Wells, an educational platform simplifying oil and gas investing for busy professionals. Their approach helps investors turn complexity into confidence and into cash flow. So, welcome, Vishal. We're glad that you are with us today. So, Vishal, I'm going to turn the mic over to you, and the floor is all yours.
Hey, thanks, Alan. Thanks, everyone. Um, Great to be here. Excited to be seeing so many participants. So let's start into into the oil and gas side. Okay. So before we start, let me just kind of share a very brief kind of a story, like how like went into this, right? So I'm a W-2 earner in one of the top tier uh, IT companies, tech companies in San Francisco, California. And I had a very good problem, which is a tax problem, right? And taxes were increasing. So I was looking for a way out to how do I can, figure out how I can optimize. And that's when I started looking into the oil and gas. And that is when I came in touch with the Royal Legal Solutions, who kind of suggested that this is one of the way we can do it. And so I thought, okay, let me look into this from the taxes point of view. but literally I fell in love with this field from last few years. And then it's not only just tax benefit, it has actually huge opportunities which we'll go through in terms of how we can generate actually a wealth, how we can set up a cyclical investment models which can continue to, you know, generate wealth, create money, where money can make money, and a lot of exciting things are there, right? So that's how I started. And I did like kind of a, I would say, a lot of mistakes also. I had few failures, I hit dry holes, I had like, you know, some of the bad experiences, but that actually pushed me more, right? Okay, like how we can actually dive into when there is $1 billion being made every day in production. How can we really figure out, you know, how we can make use of that, right? And that excites me every day and night, actually. Right. So that pushed me more, and then I started researching even more. I started going to the fields, I met geologists, I met operators, I met like syndicators. I started meeting lot and lot people, talking to them, and I started learning, you know, where is the game plan in this field, like what is the code here, right? So I'm not saying I'm like a super duper expert in this, but over the last few years I've actually really tried to learn a lot. And then some of my very known ones started saying, why don't you start sharing your research with others? And that actually led to the birth of the Wealth from Wells, where I started actually, why not, you know, if I have something to share, if we can create value for others. So we started sharing our research with others, and that's how, you know, people started joining our community. Now we have a decent community where everyone is like contributing, and like I always say collective intelligence is always, you know, helping people come with their questions, they do their research. So a lot of good things are happening. Okay, so that's about this little bit of background about the how Wealth from Wells came into the picture, right? And so let's dive into the session today. So I'll my idea about today's session is I'm trying to share my knowledge, what I've gained. I'll try to share some of the things which I think should be fundamentals. The basics are missing, and we as an investor should focus more on basics. So that's what is my intent here, how we can make sure we protect our capital and grow our capital, right? So I'll start with the very basic terminologies, what are being used in this field. And then I'll move to one of the critical dimension, which is region, why that is critical. Then I'll explore the investment models, the tax benefits, and 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 other things, how we can make money out of it. And we'll touch upon a little bit of a the core challenges, not the challenges which we generally Google it, but the real challenges which are actually existing in this field, and the real opportunities. And then I'll give share a glimpse of the investment framework network which we are following, and which is really helping us to grow into multiple deals and the investments. Okay, so let's start with the very basic thing, which is the well. Like, you know, the well is the basic unit actually here. Well, whether it is oil or gas. So we need to first, as an investor, understand what is the life cycle of the well. Now, I'm not saying we need to go into super technicals, but we should be understanding a well starts with the discovery and exploration phase, like which is generally the first stage when there are a lot of technology or scanning or the geologies or the geological data come into picture. And once the discovery stage is done, or I would say close to complete, that is when the development stage start. Typically, when we say development stage, it means the reserves are kind of a proven. So you have within development, you may have a proven reserve, but drillings are not done yet. And once the drillings are done, when we move to the production stage. The production stage is where we have the actual production starts. And then once the, I mean, other critical thing during the production is that whether it is oil and gas, over a time there is a decline curve, which also no one tells generally to the investors. So revenues start decreasing, and over the time when the wells start hitting the lower end of the production, then again there is analysis done how we can you know, extract more. the hydrocarbons out of it, they extract more oil. So there could be again cyclical loop where they can develop the fields or develop the well. And finally, whenever any well is kind of done, it's done with their life, the reserves are exhausted, it's abandoned, and that's what is the abandonment stage, right? Other critical factor from our investment perspective, what we should know, there is a like there are many drilling methods, but these are the vertical drilling and the horizontal drilling are the two core kind of a methods which is widely used in the industry. There are more like directional, multilateral, but to keep it simple, let's just think there's a vertical and horizontal. Vertical drill is basically when a well is gone around maybe 4 to 5,000 feet in the depth, and horizontal when the wells are actually around 8 to 15 to 20,000 feet of depth. That's the easiest way to understand that. And as the depth increase, the cost increase. So generally, horizontal wells are done by predominantly large operators or medium to large operators, and even large operators do vertical drilling also. But generally, that's one thing. Whenever any syndicator comes to you with the horizontal project, we really have to understand, do that project, like do that syndicator or a operator has the capability to even execute that project, because there's a lot of infrastructure and the cost or the complexity involved in horizontal. Okay, so let's move forward. These are the some of the critical terms. um, okay, so the next thing, which is another important part, we already talked about production wells, which are producing abundant wells, which get abundant. But this is the another game where a lot of operators are playing with investors. They don't talk about injection wells. Now, injection well in simple word is again something which is used to put pressure into the field to to maintain the flow rate of the production. Now, by if you go by book or by the what you say the standards of the industry, injection well is also a valid well, but it generally don't produce anything. So many a times I've seen deals comes like, oh, we have a 4 well deal, 10 well deal, and out of that, when we drilled into, we found the production well is only maybe one or two, but rest of them are injection wells. So, but technically they are also kind of a valid well. So that's one thing which I always say, please make sure we check, you know, how many injection wells or production wells are included in the deal. That's where a lot of game is being played with the investors. Okay. When it comes to the project types, again, there are like just typically there are projects which are called wildcarding or exploration projects. By name, it means that it's a new field which operator is exploring. The reserves are not proven yet, or they are trying to now go for a new exploration. Whenever someone say developmental project, means the reserves are there, they're trying to develop or start the drill into that. Again, there is a lot of complexity into this. um, how do we validate? Like I saw one of the questions, whenever someone say how to, the it's a developmental and reserves are there are specific reports, specific things which we can validate, through which we can prove that there is a production or there is a reserve there. Then we have existing production projects, which are more like, as they say, wells are already producing, and those are typically low risk projects. But keep in mind, whenever we have an existing production project, we have to see whether that project has already hit the declining curve, or that project is on which part of the curve. So and that drastically can, impact our revenue. But at least you can say there will be some revenue because the production is already there, right? And typically there are many now projects which are coming as a combination of these projects also. It don't have to be only one, it can be a combination. And that is where the large scale projects are happening, where operators are very smartly including existing production as a immediate revenue, and then including developmental and wildcarding projects. But again, we have to make sure when we validate, we see all those are on the same field or a different field. There are people who are picking up a one production well from somewhere else and putting into the deal. saying that there is already a production happening, but there is no existing production on the developmental or the other field. So there's like I said, there's these are things which you have to pay attention, right? Okay. So these were the very basic things which we should know. Like what are the basic terminologies I tried to cover, because the anytime you will hear a deal, we will basically hear these terms a lot more often whenever anyone comes to us, right? Next part which I wanted to emphasize, there are multiple dimensions to emphasize, but I think region is one of the critical factor. And anyone who is interested in oil and gas should definitely, like, I am a technology professional, I'm a finance professional, but I started learning geology after this, because I over the time I realized that if we have to be really successful in this field, again, we don't need to be super technical, but still a basic data and the understanding of geology is helpful. Okay. So when I say all of the, there are next three, four slides are actually from the data source, which is the Energy Information Administration. It's a public source. So that's one of the source which we should know, right? So the point what I'm trying to say for this slide is, like, there are top formations, or it's not that entire US is having the oil. So we need to have a basic understanding what are the basic top formations we have. I have seen projects in Tennessee being sold and getting fully subscribed. There is the like projects being done in Iowa, say sometime even Minnesota. Like there's a lot of projects coming which where the oil is not even there, but people are not aware or people are not paying attention. So that's what, that's one of the thing which I always suggest, right? And all of this information is available on our, like, there's a our US Energy Information Administration maintain a lot of data in a very beautiful way, actually. Okay.
But Vishal, I just want to break in a moment just to remind everybody that the chat is opened and this is for you all. So go ahead and when you have questions, go ahead and enter them into the chat. And when Vishal finishes his presentation, we will open this up for a question and answer. So thank you, Vishal. Go ahead.
Okay. Thank you. So moving on, so there are the different type of a data which we should know. Like, this is the data on the oil, not gas. So keep in mind. So what are the formations which are producing different type of oils, or in terms of production volume. So, like, and this is the another data, like in each of the basin we have a primary commodity. Like, it's not that everywhere we have oil or everywhere we have gas. There are only few basins where we have both oil and gas, and some are known more for oil and some others are known more for gas. For example, I've seen projects in Haynesville coming as oil. That's again you have to pay attention to that. So point what I'm trying to say through all of these slides is, like, whenever there is a oil project, doesn't matter small operator, big operator, we need to pay attention. And this there's a lot of data available where we can drill to even the field, even to the county of the project. So always ask, what is the region, what is the county, what is the location of the project, and then do your own kind of a due diligence on the location. There's a multiple ways we can get the surrounding data, we can get the actual data, and that really helps to make sure our success rate is kind of increased when we do this type of analysis. Okay. So let's look little bit into the core investment models we have. And there are, if you see in the industry, there are typically there are many, but these are the three different investment models through which the investments are being done. And there are three key components through which we make money, right? We So we'll cover one by one in a simple way, right? Again, the direct ownership model, where you have the direct working interest ownership in the well, means you own the ownership directly in the well, and there will be a deeded, most of the time there will be a deed done on your name in the county and all that, wherever the operator is doing. Then there is a syndication, which is another kind of a medium level deal, where now there are, for a variety of reasons, people are most of the operators are going with the syndications, because There are like we can always discuss in detail, but there are pros and cons of that. But typically this is like a single operator is putting multiple wells in a deal and trying to like now going to raise the money or raising the project as a joint venture instead of direct ownership, right? And only thing is, in simple word, the operator still holds the direct ownership, or sometimes JV holds the ownership. So, and the third, which is what is again the funds which are coming, where we have a multi wells. There could be single operator, multiple operators. Most of the large scale deals, which are with the tier one operators like Chevron, Exxon, you will see most of those deals are like going through funds, and those are the less riskier deals. But again, those have its own advantage, disadvantages. To make use of any project, this three component of making a money is applicable on all three type of projects. So you get a tax deduction. The beautiful part of these projects is, especially for W2 employees or anyone for that matter, actually, you can get up to 100% deduction. There are projects where we can get, but in general 60 to 80% product deductions you get in this first year itself. And that's a, like, if you're in a highest tax bracket, assume you get like 30 to 35% returns immediately back to in terms of capital in the first refund itself. Then you have a cash flow, which is the monthly cash flows. Then you have equity upside. When I say equity upside, especially there are deals which has exit strategy. Once the wells hit the peak of the curve, they try to exit the project, and that is when they can even generate even a, they sometimes kind of exit. By exit means they're selling the wells to someone else, right? Who is interested in existing productions and all that, and that is when you may get a multiple of your capital of original invested. So these are the typically three kind of ways to make money out of it, right? Okay. Now moving on. So what are the simple, or I would say core challenges and opportunities we have in this field? Now again, like there are multiple challenges. There are a lot of ghost stories everyone has heard, but I would put there are like I know, and that was the first question I saw, that due diligence is one of the biggest challenge, because there are not many credible sources available. And but if we do some research, there are few credible resources are available, but then the awareness is very less on those resources. And even if there is awareness, there's a cost engaged to those also, right? Like for example, there are subscriptions available which we can take and through which we can validate a lot of things, right? Then there's another very critical challenge which is in the industry, and this is very important thing, that this industry is highly divided industry. Means you can imagine, based on my research, the and this data is, again, even if you do it or your own research, you can find out easily from anywhere, but I'm just saying like that 80% of the production is actually done by 5% of the operators, and those are our top operators, like our EOG, the Chevron, the Exxon, the Continental, right? Now, rest of the 20% production is actually done by 85% of the small scale operators or medium scale operators. So, whenever you're evaluating a project, understanding the operator profile is very critical, right? Another thing, like from last 10 years, there has been like at least 5 to 7 thousand bankruptcies filed in this. So you don't want to be the one where you're attached to the operator and filing, who's going to file or might have filed. So right. And in terms of investment, one of the major other challenge in this field is like, how do we price the project? What is the valuation model? Many operators are coming saying a unit is 100K, someone is saying unit is 250K. So there are, so we need to develop little bit understanding on the pricing and valuation to be more successful in this field, and the cost structures. And for credible sources, I already mentioned, like there are like, if you ask me, based on my experience, there are many other people say challenges that their oil will be, is it declining and all that. I don't, honestly, based on my experience, those are really not the challenges. Some of the challenges are this, which we need to understand very carefully, right? Okay, so let's go to the opportunities. Okay, so while the challenges is there, it's fine. But what excites me every day is these opportunities, right? The energy consumption is relevant more than ever, right? I mean, with we are hearing this AI, data centers, energy demands, everything is energy demand or consumption is going to increase like anything, right? There is a 1 billion worth of production being done every day. And with the increase in efficiency of our technology, the well productivity has actually increased a lot. We, like operators of technologies, has find a new ways to extract more oil from the same wells. So there is a higher well productivity now. Now I know there are bankruptcies, but good part is those, the elements are getting punished automatically. So we have fewer operators now, which means quality is actually replacing the quantity now, right? And then the tax, I can't re-emphasize again and again. Like, I don't know if there is any vehicle which can give me 100% deduction on my active income as a W2, or anyone who can, even you're a doctor or a real estate or entrepreneur, it is being done for everything. Same for the drilling success rate, because because of this whole technology and AI, the success rates which were used to be in 60s percent in 80s is now actually 90%, and it is increasing. So which is again another very great opportunity, that chances of our capital efficiency is increasing, right? And then we have a much stable price cycle now as compared to where we used to see up and down, right? Okay, so there's a lot of many other opportunities, but these are some of those opportunities which are really good, right? Okay, so that led to move to the our last part. What is the, like, now that we know, you know what is our, what are the basic units of a well, why region is important, what are the investment models, what are challenges, opportunities. So then what is the investment framework we can
So,
use?
Michelle, just let me make one more reminder here that
Yeah.
the chat is open, people, and go ahead and put your questions in there so we can have an engaging conversation with Vishal. As I've been listening, a lot of questions have come to mind for me, and I'm sure the same is true for you. Um, unless you are highly familiar with oil and gas investing. So go ahead and put those questions in there. Vishal will be wrapping up here in a moment, and we'll get to all of your questions.
Yeah.
Thank you, Vishal.
Thank you. Yeah, so now that we know there are multiple dimensions, I'm not saying I've covered all the dimensions, but to keep the thing simple, I've tried to touch upon the basic dimensions, which are minimum basic fundamentals we should know. And then the game is all about how we put together the all these dimensions, validate, put the data analysis in picture, and then drive a investment strategy out of it, so that our capital is well allocated, and we have now better risk reward evaluation, and then we can set up a repeatable, scalable model which we can repeat every year, or like over the years, right? So that's the kind of investment framework. When we look into any project or during our coaching sessions, we talk about that. We like gather a lot of these things and put together, and then evaluate how things work, right? Moving on. So I'm almost done now. I'm just giving little bit view, like what we are also doing. We have also like kind of partnership. We are like all there are multiple people in our community. They're all highly like committed to oil and gas. We have now partnership with lot of tier one industry leaders. I directly talk to geologists, operators, even we have now access to EOG, Chevron. So we are growing in terms of our access, and that partnership is helping us to learn more and more. And that's what we try to share that with everyone. Then being from the technology field, we know how to use technology to get better due diligence. We know, what are the subscriptions we have, like some of the subscription, like I was saying. For example, there's one subscription to I don't know if people who have invested, they might be knowing about drill info, or there are environ, there are subscriptions are available, which are actually, which cost actually 15 to 20K per year. Now for every retail investor it's not feasible, so we kind of group together and have access to those type of subscriptions. Then we have, since we invest a lot of deals, so we have a lot of kind of ready deals which we share, or like which help people to select on that, right? So that's what we do in terms of, and then we actually, another point which we go very detail, depends upon the person who wants to invest 50K or a million or 500K. We then kind of design a very personalized way, like we work with them and help them to go through, how they can design the framework which can work for them, right? I think I'm mostly done. This is just some of the sharing, which we went on the field, boots on the ground. We we actually, like, these are some of the wells which are actually owned by myself. I've seen which how to do the testing. I learned how the testing is done, how the mud logs are read, and all that. So just sharing with everyone that it's just not a theoretical thing. We actually work directly on the field. Okay. So I'm mostly done. If just this is just my information, anyone wants to contact, feel free to contact me. I hope I've shared some basic information. It might, help you to take some next steps. But I can only say this is a very, very great field, with highly, lot of great opportunities, lot of tax benefits, and just I think we just have to learn few things and then go for it.
So Vishal, if you would just go ahead and put your contact information in the chat so that people will have a way to go out and reach out to you. So thank you so much, Vishal, for laying out such a clear strategy for us in this very unique class. I just I've not invested in oil and gas, so it's a new field for me. But just you're going through it, it just I really understand how complicated this can be and how important really getting educated in this before doing an investing is. So, for those who have just joined us, this is Wealth Briefs. We're we're here exploring a powerful, often underutilized investment strategies for high-income professionals. Vishal Grover has been with us as our presenter tonight, and his topic was on investing in oil and gas. Before we go into the question and answers, we are contemplating changing the time for wealth briefs. And I would just like to do a poll here. We don't have a polling tool, so y'all, I need to pop over to the chat, and if you would just put down your preferred time for wealth briefs. Um, Anytime between 5 o'clock and 7 o'clock on Thursdays. Be sure to put your time zone in there. It does us no good if we don't know your time zone. So go ahead and pop over to the chat and just go ahead and enter your preferred time for wealth briefs. So let's go over to questions, and let's get back to Elliot's question. You did address that to some degree, but let's go into that a tad bit more. Uh, because with any new endeavor, or in Elliot's case, he has been involved in it and once burned, twice learned. And so there's a lot of hesitancy, certainly, to go back into something where you've been burned once. And there's a lot of fear and mistrust and conjunction for those of us who've never been in this field. So give us just a little bit more depth in terms of the vetting processes that you go through. And well, just answer one question just for me so I have a clear picture here. Your company is not a drilling company, right? You are an investment company and you invest in the drilling companies. Is that correct?
That's right.
Okay, so with that as an understanding, give us a clear picture of how you all vet those properties so that if we come to you, we can actually have trust in the fact that you do know what you're doing and where we can place our investment with you so you can invest it in a proper investment.
So whenever actually we do there, like I said, there are multiple sources, but if I have to classify, there are like three types of validations, which are at a very broader level. Like validation of the business who is offering us the project, then validation of the project, and then the validation of the owner actually, right? Because like I said, when you have 85% small operators, if I tell you like most of them are like actually 2 to 3 employees, like, and they don't even have offices, so most of them stay on the field, which is one way. But so validating three components, and then the access to some of the very credible industry level sources like Enver and Drill Info, where we can go to the, like, anyone can tell me, okay, I have a field, I have a well, I have this and that, but we can validate the data up to the well and the level of the field, that what is the production which is having and all the surrounding productions, that is about the project. Then we do the background check a lot on the business. There are ways to do that, right? And we do that, and we do a background check on the owner as well, right? We check the bankruptcies. So to keep it simple, I would say it is definitely, I understand it is complex, but at the same time there's a lot of good data available. For example, in Texas, the Texas Railroad Network, which is called TRN, they also have a lot of data. You can go and validate the licenses, you can go and validate the drilling permits, you can go and validate everything, and it is available free to everyone. It's just that people are not aware about that, right? So so that helps us to increase the confidence. And now with our network, we actually do sometimes a lot of cross validations also. So for like we validate for one operator with other operator, because they, we see sometimes if there is a bad guy who everyone will say bad about that, so that's part of our background check. So like we are linked to multiple operators, so sometimes we do a lot of cross validation, because our money is our money. We want to make sure we protect the investor money, our own money. Like we ourselves are invested more than anyone else actually, right? So a lot of these practices has helped and evolved over the time. And with this, there are certain technology related, like we have developed some AI prompts and all that, through which also we can do much better validation, it in a much lesser time now actually, right? Right.
Well, appreciate that, Michelle. I'm going to combine two questions here because they both deal with taxes. And uh, uh, so one is just what is the deduction range based upon? What are the factors that you're basing that 60 to 80% on? And the other question has to do with is there a way to get the first year depreciation to offset active W-2 income? So if you could address the tax situation there.
So tax deductions are typically dependent on the IDC, which is called drilling cost, which is like a, the dependent directly on the drilling cost. Means if you have an exploratory project, if you have a new exploration, the cost will be more and you will have a better tax deduction. Up to that is when it start hitting maybe 90 to 100%. Then then if there is an existing production where the wells are already drilled and you have a production, so your ongoing cost is less, so that is where it hits the lower end of the bar, which that those type of projects may have 60% of the production. So in simple words, it is actually ranging based on the cost involved in the project. And that is why I was saying the understanding the cost structure of the project is very critical. That impacts not only our tax, it also impacts a lot on our returns. So so especially in funds type of a deal, there's like a lot of indicators are kind of masking a lot of like cost or adding, like even if the cost is 60%, they have ways to show it to 80%, 90%. So so but in short, yes, that's how the deduction is actually dependent on the drilling cost, right? Intangible drilling cost, if you ask me, like it is, which is called IDC. And then you have a 15% kind of a deduction which is allowed on the on the revenue as well. So there are two kind of cost reduction. And now there are more and more deals coming where you can do even a 1031 exchanges also. So it is because by category, oil and gas is now treated as a. I'm not a tax expert. I think Pete and from real is the right expert, but I am just sharing. Um, like recently we have come across the 1031 based deal also. You can even now invest through IRA and all that. So a lot of exciting things are happening. Yeah.
So before we leave that again, so a 1031 is a like kind of exchange. So I'm assuming that it's from one oil well investment to another oil
Yeah.
investment. It's not, you can't go from oil and gas to real estate. If
Actually, I don't want to comment. That is something which we are exploring. Some of the tax experts told me that might also be feasible, where you might have a capital gain from your property and you could offset with the that. But I'm not that was one of my area we also wanted to understand, like, because both are classified as a real estate assets actually, right?
okay,
Right.
we'll definitely check with your accountant on that
Definitely.
before you think about doing that
Yes.
1031 there. So another question we have here is what or how often do you hit dry wells? I guess what is the percentage of dry wells that your company has been up against?
So I would say, like, so far we have done, I would say we have 90%, like whatever projects which I have selected, even where I am kind of invested, we hit dry hole very early in some of my, like I said, lack of the knowledge at that time or lack of the experience. I was not even aware this. We can check this type of a data. So we hit definitely dry holes, and some of the examples which I've given was actually my own examples, right, where I subscribed to the project in the state where I ultimately learned there is no oil in that state. But I was just desperate to save tax, so we just jumped into it because it was having 100% deduction. Then I came to know how they are able to give 100% because they hit 100% loss through dry hell. So yeah, the success rate now we have, like, I would say, because now we do deal only with the tier one operators, like for example EOG and Chevron and Continental. Our that is almost, like, I would say 95%, 90. It is actually more. I'm just still trying to be conservative because they have the best of the technology. They have the uh, best of the everything in terms of infrastructure. And like I said, the success rates of drillings are increased a lot. So recently, for quite a long time, we have not hit after we change the approach, and that is helping us a lot. Yeah.
And could you provide an actual example, a historical example from your investment portfolio, and just kind of walk us through that from just summarize a walk through that from beginning to end?
So if you ask me, I have tested all the models, like whatever I said, all the models. So when I say tested means testing is actually a real time through my own investment, right? So I am invested, have in all type of a model. The our returns and risk and rewards are different in different models. Historically, on a conservative basis, if I have to say, like, if there is an like I have a, currently the minimum project which I'm, honestly, don't quote me, like it is running more than 20% return. I would say whenever I say around 20 to 25% is actually a reasonable returns on very good project. If you add the tax benefit, it may raise to 30-40 in your first year, right? But then those are more into the drilling projects, right? But this is one area where a lot of game playing is happening. If I have to share with all of you, like, if there are operators who are showing 70, 80, 90% returns in first year, right? I'm not saying that is not possible. Even one of my own project, I have getting like more than, I've hit like 70% return in my first project in one of the well. But then again, like I said, those are not like a common scenarios. But if the real, I think the realistic expectation, if we are getting 20 to 25% returns, that's a good thing. And in most of my investment, I'm hitting that target. That's what I keep in my mind. Like, because a lot of time people, I think, come to me saying, I think I can make 5x. This is like a, I don't know where is the magic here. Right? Like, it's a science actually. It's and the financial and mathematical models, if we put together, and the realistic, I think that is where a lot of mistakes is happening actually. Like, if anyone is telling us 70-80%, that's actually, I always say it's a red flag. Like,
Well, thank you, Vishal. So, is there a minimum investment, generally speaking, and what is that? And is this limited to accredited investors, or is it open to sophisticated as well as accredited?
so to my understanding, this is open mainly to accredited investors, and the minimums are like, varies from project to project. I have seen the project with minimum as 15K, and then in general, if I have to say, that 50K to 100K projects are there. But then a lot of operators allow partial kind of a units also, where you can take a fractional ownership. So so sometimes the small operators may allow you 15, 20K. So it starts from there, and then there are, like, on the upper limit, I think generally like 100K to, I have currently, we are doing 125 million deal, where the minimum is 100K. So that is with the EOG. So that's a very fantastic deal. So there are multiple projects, multiple operators we have to study. But yeah, yeah. And it ranges actually. I can say I have seen project even with 10K, 15K, right? Right.
David, in answer to your question, Royal Legal Solutions, if you go to their vault deal, you will find that there's several oil and gas opportunities listed there, and some of those Royal Legal Solutions has invested in, some of them have not. So you need to do your own um, due diligence work on those, as well as any investment that you actually go into. Let's see, what is the typical time period for exit, and what percentage of your principal can one get back, assuming exit would be at a lesser price? Is that even possible? Can you exit? Can you exit early, or are you in there for the long haul, no matter what happens in your life?
Yeah, actually, that is one of the another challenge in in this field, that you don't have any formal exchange. Like, there's no stock exchange where you can go and sell your stock, right? So, but at the same time, it's not that exit is not possible. You can still sell your working interest, and through trusted kind of operator, and that's where even sometimes we help people to get the exit. But there are deals sometimes designed with the pre-planned exit, right? For example, the deal which I just talked about, 25 million, it has a 3 years exit period. So it is, those syndicators are actually known for exit based deals. So, but typically, if you have a operator linked deal, which is direct ownership kind of a deal, those have like 15 to 20 years. As long as will reach the abandonment stage, they will run, right? Because that is what is their business. But if you are looking for a exit based deal, those are also there. Typically 3 to 5 years exits are there, right? And in terms of multiple, I would say, if you are getting a, again, if someone, you will see, I have recently yesterday we evaluated one deal where they were saying 5x multiple on exit, right? But I don't know how they will achieve that. But typically, if the exit what I have seen is like, if you are getting 1.7 to 2 X of the exit, including your tax and all that. That's a very good exit, I would say. Right. That's what we generally like. We have seen that, right? During COVID, I've heard like when the oil price hit suddenly 120 and all that, a lot of deals did made like 5x. I validated the data, but now with the price stability, I think the exit is typically 3 to 5 years, and with the 2x, 1.5 to 2x is the reasonable. Again, keep your expectation, what you say, practical, and this is no magic. Actually, I keep saying to everyone, right, but we can still make. I mean, if you're getting 20% return, I don't know which other commodity is actually giving us, right?
So, in multifamily or in commercial real estate investing, when operators get
Yeah.
in difficulty, they have what they call capital calls. Is there a similar kind of thing that could happen with an oil and gas investment?
Yeah. Sorry, I missed your question actually.
Capital calls, uh, the operator needing additional capital to carry the project through after the
Yeah.
initial.
So yeah, so there is something called uh, right to refuse, right?
Mhm.
So like especially in direct ownership projects, over the time when operator hit like a declining curve, but they are very confident that there are more reserves that can be extracted, so they can come back to you saying, okay, if this is the new capital, if we add it, then we can, re what you say, re-extract the L or restart the well, and that is time. But you generally have a right to refuse over there. Only thing is, if you refuse, you might lose your ownership. So those type of capital goals has happening, right? But in the large operator, during the that is why I like more like a tier one operator, for if you want to do a very kind of a longer term cyclical kind of investment strategy, then those type of operator like EOG and all that, they don't generally come to us actually, right? I have not seen that, right? So yeah.
Of course, with any capital call,
Yeah.
it's going to dilute your investment and your
Yeah.
returns.
Yeah.
But so I think the question was in terms of your company, have you had capital calls? How many capital calls have you had?
So in one of my project, I was participating like in an existing production project, and the well was already like a 15 years old. When I took the well, it was around 12 years old, and then it gave the very good return. And that is, I mean, that in one of the project I did face that capital call, I would say, right? But normally that happens more like it. What I have observed, it is more linked to the declining curve of the asset, or sometime, like I said, some operators have many. If they have to scam us, then there are different ways to send us the expense bills and all that. They'll say there's a lot of water coming now. The water disposal is one of the challenge. I've not gone to detail. So oil, it's not that when oil comes, it's not just oil comes, there's a lot of water comes actually, right? So they have a lot of water disposal cost also with every well. So sometime it start going way higher than even oil revenue. So 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 that's when they have to set up a new injection wells and things like that. Yeah.
Well, there's no such thing as a risk-free investment. Well, thanks for sharing that, Vishal.
Yeah.
So your exit period, just a little bit of clarification on there. Is it typical at the exit period that that investment ends, uh, or could it be that they could flow their money over into another raise for that particular well, or is the exit period mandatory?
Yeah, I mean, this is something we have to pay attention into their PPM. When we sign the PPM, generally these things are mentioned. There can be a situation depending upon how the joint venture is structured, um, and how the but simple answer is it both are possible. Like in there are deals where you may have option to continue, and there are deals where they might go with the majority voting. So it depends upon how the JV is structured, right? Yeah.
So I always read those PPMs and operating agreements.
Yes.
Same as with any syndicated investment there. So our governing bodies like the SEC governs most syndication investments. Is the SEC or any other government body involved in monitoring oil and gas investments? And are there uh, are there regular audits or periodically audited? How's that working?
Yes. So SEC definitely is one from the investment point of view, but uh, each state is having their state, like all the oil is mainly audited by the state governments. For example, in Texas, the Texas Railroad Network (TRN), they do a lot of auditing in terms of whether the well is, like, produced as per the environmental standards. They do the auditing whether it is, like, there is no uh, over, what you say, utilization. So simple answer is yes, there are, each state is having the audit bodies, and we need to check the data because sometimes wells have too many violations well before. So we have the way to check whether the wells are having any audit violations or not, right? So we can get that validated through these audit bodies, and that data is available. Yes.
Okay.
Okay.
Well, thanks, Vishal, for all of this great information, and thank you to all who have been tuned in tonight. You can get more information if you go to Vishal's company's website, and that is wealthfromwells.com, www.wealthfromwells.com. You can contact Vishal via email at the corporate at wealthfromwells.com, and Vishal's. So today's session shed light on really a powerful strategy that's been hiding in plain sight. And Vishal Grover gave us a closer look at how oil and gas investing, when done strategically, can offer high income professionals a rare trifecta, and that's passive income, significant tax advantages, and ownership of a real asset that is a cash producing asset. So thank you, Vishal. And also I want to thank Liz for providing the technical support. As always, you do a tremendous job. Really appreciate that. And I want to thank all of you who are here tonight, and thank you for taking your time to be with us. And we look forward to being with you next Thursday as we have another round of wealth briefs. And so mark your calendars for next week. We're not going to be changing the time next week. If we do change it, it will be at least 4 to 5 weeks out from now. So same time, same place next Thursday. Liz will keep the chat open for another 15 minutes. If you have additional questions, go ahead and pop those in there and we will get them over to Vishal and see that he answers those. If you have any other comments that you would like to leave us, anything you would like to see on wealth briefs, or ask that we do something different than what we're doing, we definitely want to hear from you. I'm signing off now, so thank you all for being here. We'll see you next week.